Ladies and gentlemen, welcome and thank you for joining us for this important conversation. Now, we all know the importance of public-private partnerships and the role that they play in unlocking economic growth through infrastructure development. They certainly offer complementary sources of finance to public investments and also offer solutions to some of the challenges that are experienced by the public sector. And I mean, certainly from Transnet, and you would have heard from some of the conversations that happened earlier, we definitely understand the importance of PSPs in unlocking value for our economy. However, one of the challenges that have been noted is that Africa is ranked amongst the lowest when it comes to infrastructure development, investment, and preservation. And in an article that I read, and I think I heard one of the other speakers make reference to it earlier, is around the infrastructure financing gap that is experienced in Africa, being estimated at around $100 billion US dollars per annum. And one of the factors that affect deal flow is the inadequate capacity in identifying, developing, structuring public-private sector projects that are bankable to bring to the market. Now, on the back of that, I would like to invite each of you to please talk to us around some of the infrastructure projects that each of your institutions have been involved in across Africa. And if you can, please also just highlight what are the challenges that those projects aim to solve for. And I think most importantly, to also just understand or unpack what have been the success factors. I think it's quite an important aspect to also touch on. I'm going to approach this panel discussion differently in that I'm going to allow each of you to please talk to or respond to that question, and then we'll get into the next round of questions. So I'll start with you, Mr. Khana, if you can talk to us about the work that the AFC is doing.
Sure, thank you very much, and it's a pleasure to be here. So just as an opening, so AFC is an infrastructure finance provider, one of the largest on the continent. We've been in existence for just over 17 years now. We have a balance sheet size of $13.5 billion. We work on the construct of member countries, so today close to 95% of African sovereigns are now members of AFC, of which close to 15 of those countries are now equity members of AFC. So as an infrastructure finance provider, we provide long-term capital, predominantly to reduce the infrastructure gap on the continent. We have participated in a number of private sector transactions, sovereign facilities, as well as project development for key infrastructure projects on the continent. And really, the response to the question largely speaks to some of the thematic issues that we see today. So first being the need, as you mentioned, to continue to invest in infrastructure to the extent that it closes the gap on the continent. The second is to address the current economic impacts that global climate change and sustainability is having on our ability to grow that infrastructure. And then lastly, in order to source the relevant capital that is able to provide the long-term capital needs of these projects. And lastly, I should mention also speaking to the interconnectivity that the projects have across different countries and the continent at large. Now, some of the projects that we have been involved in, to the extent that they provide for a lot of these thematic issues, are ones like the Lobito Corridor, as my colleague had spoken to earlier. Now, this is a close to 800-kilometer greenfield development of a rail project that's meant to connect the mining resources within Zambia, the DRC, connecting into an existing line in Angola through to the port of Lobito. That project, at this point in time, is instrumental to these key countries. We're the lead developer on the project, and what that is hoping to solve is for the ability to extract the raw materials that will go into the electronic vehicle environment, but also not just as an extractive industry, but also to promote the manufacturing and beneficiation of these products before they're exported. The next project that I'll speak about is another rail project in Nigeria, which is what we call the Kano Maradi Rail Project. This is a close to 300-kilometer rail project that starts in the north of Nigeria all the way into Niger. This project is a $2.2 billion project. We as AFC are one of the mandate lead arrangers on that project. That project in itself is expected to transport over 27 million people, promote economic activity within the area of northern Nigeria into Niger, connecting these two border towns, which will facilitate additional trade activity. Now, this particular project solves a number of key issues. The over-reliance on road networks, which on an annual basis needs to be rehabilitated. But then secondly, the ability to move large bulk cargo between two countries that need that trade activity. The last I'll speak to is a power infrastructure project, which slightly sits outside of transport, but really speaks to the ability to have a collaborative effort between countries. Recently, we participated in a €500 million transaction to develop a 128 megawatt hydropower dam in Senegal, in the north of Senegal, in an area called Kedougou. This project in itself benefits 4 countries, Senegal, Guinea-Bissau, and the Gambia. This project is effectively going to create an additional platform of power generation that will spur economic activities within 4 regional countries. Now, when we look at these projects, we look at the ability to build into the value chain. So all of these projects in isolation are as significant as they are, but what we are focused on is the downstream effect that it has on the rest of the economy. It's not just in the country where it's being built, but in the surrounding regions.
Thank you for that. I think one of the things that I like about one of the projects you made mention to, and we can certainly resonate with that, it is around how you're looking to obviously assist in the moving of cargo from road to rail, and that's definitely something that we are also quite intentional about. Can I ask you then, Ms. Portia, to talk to us then about the role that the ECIC has played in the continent and the challenges, again, and some of the success factors?
Thanks. I think maybe one of the comments that we get a lot is that they don't know who the ECIC is and what we do. So I will start by saying that we are a state-owned entity. We're under the Department of Trade and Industry. We are South Africa's export credit agency. We are not we don't provide guarantees. We provide insurance, but we work like a lot of other OECD ECAs. And we provide political and commercial risk insurance. And the support that we provide for transactions is threefold. Directly to the manufacturer. As South Africa's ECA, we're there to support the export of South African goods as well as services. So the support that we provide to manufacturers and exporters is varied, but it could be of pre-export finance, where a company has got an order and has manufactured and is about to ship out their goods. Then all of a sudden a political risk event takes place, maybe war breaks out, and we are able to cover them for the cost of what they had put into that order. We can also provide support in the form of working capital cover and guarantees. So they will work with their bank as usual to provide working capital for that export contract, but we will cover the bank for up to 90%. For the working capital or the guarantees. It could be bid bonds, advance payment guarantees, performance guarantees. Throughout the day, we've heard about the constraints, the financial constraints that a lot of our OEMs will suffer from. So when we provide that cover to the bank, to the value of 90% in the form of guarantees and working capital, it means that the manufacturer or exporter does not have to provide cash collateral for up to 90%, and which enables them to utilize that cash for other projects, either domestically or to bid for more projects on the rest of the continent. We can also provide support to the financiers themselves. So they work with yourselves, and as you know, when you get your credit lines, there is a limit. It's not infinite. And what we do is we provide cover to the bank, and then they substitute the project risk in that country or the counterparty that they're dealing with that of South African government. So our role really is to crowd in financiers to finance for those projects. If you look at the ECIC from inception, we have been involved in various projects, rail related. A lot of them that have worked very well, I say, are really where we have private sector involvement. As you can appreciate, there are constraints with sovereigns, and we see it a lot in the inability to provide guarantees for projects which a lot of lenders need or require to have to manage the transactions. So we do provide comprehensive cover from political risk. So political risk could be events like currency unavailability and convertibility. It could be war, civil disturbance. In the case of assets moving, it could be also terrorism, expropriation, protracted default by the sovereign as well. And we also provide commercial risk cover, which would be insolvency and protracted default. So what we effectively guaranteeing is that in the event that things go wrong, you can come to SA government to make you whole, and the project continues, and we remain in the transaction, sovereign to sovereign, until the project maybe turns around or it gets back on its feet. But it enables the South African exporter to continue to do business, which is what we want them to do, and to generate exports. We've done projects in Botswana, DRC, Zimbabwe, Zambia, and under a variety of structures, lease structures, some of them outright purchases, etc. And maybe most recently, which hasn't gone very well, is support for rail project into Ghana, which was for the sovereign, and it was an infrastructure development project. But fortunately for our South African exporters and our lenders, they were made whole, but we have paid out claims, I think, to a value of about $80 million. But that just solidifies the value of not going into those transactions without your ECA support.
Thank you for that. Yeah, I definitely agree that the role that the ECIC plays is quite important in facilitating export trade for South Africa. Mr. Mike, if I can then ask you to please speak to the work that the AFDB is doing in the continent, and again talking to the challenges and some of the success factors.
Thank you very much. Good afternoon to all. I think this morning the Vice President in his opening speech has actually provided a strategic role of the bank, what the bank does on the continent, by providing financing for development, but not just financing, but also policy advice to its regional member countries, and also building institutions that contribute to actually, drive development on the African continent. We do this by providing few, instrument of financing, what we call typically a public sector financing instrument, which are loans that we can provide with a long-term view, and then concessional loan, and also some, market-based rate, which is nevertheless a very, very low rate, because we are a AAA institution, and we are able to raise funding at a very affordable cost that we pass on to our client. That is our developmental mandate, that give us that kind of possibility. We also provide a loan to private sector. And I think this is a topic also here about PPP, where we provide loan, equity, quasi-equity, mezzanine, and so on, and also guarantee that really help to catalyze private sector investment on the continent. And also this, compared to what we can see on the market, is actually long duration. That's one of the competitive advantage. And also, if you calculate all the costs of funding, it's also very, very competitive as well. So that's, again, to use our heart of development institution. So coming to PPP, I think, the bank has overall supported, I'd say, in the last 10 years or so, 78 PPP projects on the continent, totaling 4.7 billion in terms of commitment. And that's across all the sectors, transport, energy, water, and so on. And some of them have been very transformational in terms of the PPP experience of the countries that we are supporting. Just to cite a few examples, Lake Turkana wind project in Kenya, actually one of the largest wind power projects in Africa, and also the single largest private sector investment mobilized into Kenya in Kenyan history. So this is actually very transformational. It has actually provided, very clean power for Kenya ahead of many countries, because this is some years back in 2013. And the bank played a lead arranger role in this particular one, and then provided also about 853, a lead arranger role for 853 million to support that project. The second example I can give is in the water sector. Some of you here may know Kigali bulk water project, which is also the first, PPP project in water sector in Rwanda to really provide potable and clean water, the bulk to people of Rwanda, and which has also been very transformational because, it's also one of the first, largest private sector investment mobilized into Rwanda. In transport sector, we have done quite a few PPPs. I can just mention a couple of them. One is right here in this region, the Nacala project, Nacala Corridor project, whereby we joined forces with other DFI to, link the port of Nacala, the mining region of Tete in Mozambique through Malawi to Nacala port. That is a landmark project that we actually financed through a PPP, and that was the only way we could actually mobilize the scale of financing that was required. So again, the catalytic role of the bank was actually demonstrated there. In Dakar, we're also very present in the urban space to really, facilitate urban mobility. So in Senegal, in Dakar, we have actually, done a PPP project, one of the first in the country, on the Dakar to Diamniadio toll highway, which is, a significant project to really reduce the time it takes to go from Dakar to the airport, and thereby also reducing the CO2 emission and so on and so forth, because less time in traffic and so on to do this thing. And then the last one, which is also home where we are based, our headquarters in Abidjan, is what we call Henri Konan-Bédié Bridge, which is a landmark bridge that we have actually helped to structure as a PPP, and today it's become a very good time saver for people of Abidjan that will navigate between the Cocody area to the airport. So these are some of the projects that we have done. As I mentioned, 78 in total, and recently we have approved our PPP PPP framework. That is not because, that was back in 2022. It's not because, that was the first time the bank was doing PPP, but because we had an approach that was not targeted or unified. So the framework allows us to really signal to the market that the bank is serious to scale up in, PPP by having the three key pillars. One is enable environment. I think colleagues have already mentioned that the critical importance of having the right enable environment to drive PPP is critical. And for this, in our countries, it has to go to regulatory framework and also capacity building for those institutions that are involved in this thing. The second one, which for us is a game changer, is what we call Pillar 2, is project preparation and advisory services. To really drive the pipeline of PPP, you need to invest in advisory services, because that gives you the PPP program and also capacity that countries are actually, required to actually have a long-term view, for their PPPs. And the third one is what we have been doing from day one, is financing. These also come with a new innovative product on, like partial risk guarantee. My colleague here was talking about risk, and then also, partial credit guarantee. Those are instruments that really help to de-risk or credit enhance PPP project to really catalyze that investment. And I think we have been deploying these very successfully in many countries. But that said, PPP is very complex undertaking. And we also tend to say that it's not to be seen as a financing instrument. It's a delivery mechanism. It's really to enhance the performance of the asset that need to be built through private sector innovation and private sector financing also, most of the time.
Thank you for that. I think 78 PPPs is quite a commendable record. Mr. Simpiwe, if you could please also just talk to us then about the work that DBSA does. I mean, we heard from the previous panelists, but if you can complement in identifying then the key projects that you've participated in and highlighting some of the challenges and the key success factors.
Okay. No, thank you so much. I think, yes, my colleague has done the work in terms of introducing the DBSA. But for me, I think the key is just to highlight the fact that perhaps in the audience, people may not know that the DBSA is working in the continent. About 7 years ago, we started a team that focuses directly on East, Central, and West Africa, because our traditional market has been South Africa and Southern Africa. Glad to announce that, we started the team, and the exposure of the DBSA in that market was less than 4% of the total book, but we're now quickly approaching 20% of the total book. DBSA is around 128 billion rands in terms of its balance sheet. And in that exposure, in terms of PPP projects, we are sitting pretty much 50% of that exposure in the outside of SADC region in the PPP space. Whether you are talking LNG terminals, gas pipelines, gas-to-power projects, TVET colleges being run on a PPP basis. That's essentially we've been there. Most of the projects that we've been, the colleagues have mentioned, we've partnered with them. We work very closely with all the colleagues that are here. I think for me, it's to really zoom into the challenges, right? And so, common themes that we see across a lot of projects. Related to what one of my colleagues mentioned here, the issue around policy commitment. I think there's just our policies in the continent are geared towards curbing malfeasance rather than increasing efficiencies when it comes to execution. Rightfully so, as a continent, we've experienced a lot of corruption and so on, but what I see this has done is that our policies are geared towards that. Let me make an example. For an example, the time it takes to take a concession approved, it takes an extremely long time. A time it takes to just get an amendment for a concession agreement, it takes a long time. Now, PPP projects, by their nature, they face a lot of dynamic aspects. So by the time you get the amendment in place, a lot of things have moved. EPC costs have escalated. Your permits have expired. A number of things that were critical to the bankability of the project are now not applicable. Interest rates have gone up. Now the project cash flows are not making sense. You now have to go and negotiate and open another discussion now that talks to tariffs, right? That becomes also another year. So there's just that sense of us focusing more on corruption and curbing corruption rather than also incorporate this very important element that talks to the time. And that's just that sense of urgency that we're not picking up, whether we're talking from us as financiers, as government as well. If I look at us as financiers as well, some of the things that have frustrated me with some of the colleagues that we work with is, why are we having decision makers only sitting maybe once or two times a year? There's a sense of urgency in the continent. There's a 100 billion gap in terms of infrastructure, but that sense of urgency I'm not really picking up in terms of how we do things. Then the other element is projects that are not well structured from a bankability perspective, right? And it could be a number of things. It could be a number of things. It could be just the pure structure, the financing structure. It could be, a PPA that was not considering the term of the financing that would be required. And I guess this also speaks to, your lack of project development funding. That capital is very scarce in the continent, and I can count in my hand the institutions that are able to provide this kind of capital. And also another element that I've picked up is that generally our project developers and our state-owned entities, they don't necessarily want to use experienced financial advisors. Just want to put it out there, I've seen the value in projects and the success in projects where a project has actually appointed an experienced financial advisor. And project finance is an expertise, right? So if you are in corporate finance, in a corporate environment, it doesn't necessarily mean that you are a project finance expert. But when we've seen that where a project, either it's done by an SOE, but there's a project finance expert within the SOE, or they hire the services of a financial advisor, we've tended to see those projects doing very well because that financial advisor is able to anticipate some of the things that we will want as lenders. And while the concession agreement, as an example, is still being drafted and negotiated, they're able to put in that valuable input that then prevents us, when we come in, to then require those amendments, which I then said that they will take 2 or 3 years.
Thank you for that. Ms. Nina, I'll allow you last to then talk to us about the work that the IDC is doing.
Thank you. So the IDC is the Industrial Development Corporation. Our role is industrialization, both in South Africa as well as the rest of Africa. And where infrastructure is an enabler of that industrialization. To date, we participated in more the private sector play support. Most recently, we did, there's a project we did in Uganda for energy as well as logistics. It was a combination, as well as cold storage in East Africa. We have just recently revised our rest of Africa strategy to include all these projects that everyone is working on. I know we're working on with most of the other DFIs or most of these corridors. And talking to the corridors is really that we don't do infrastructure indiscriminately, that it is linked to industrialization. On the challenges that we've experienced, what I've seen at least on projects on the continent is more on the exchange controls. It really it's basically a question of the revenues that you're receiving. If they're in local currency and you have a weakening currency against the US dollar and something happens in your project and your prepayments go out a little bit longer, that becomes a challenge. And the other one is changes in regulation. You don't anticipate changes in regulation at the beginning of a project. However, things do happen along the way. And really what I've seen as well is that the success of projects is in the design. Everyone's spoken about project development, project preparation. It's really in the design of the project upfront, whether you are ring fencing your revenues, whether it's making sure that you've got the best lawyers preparing your legal agreements, market studies that you've really find, independently verified your market studies. So really it's in the design that your project will succeed. Thanks.
Thank you so much, ladies and gentlemen. We have run out of time, but this has certainly been an